Hey, thanks, Sam. And thanks to all of you for tuning in today. We're going to be discussing the Consumer Financial Protection Bureau's amendments to Regulation Z that set forth new ability to repay requirements and that also articulate the standards for something called a qualified mortgage. And you'll be hearing all about what a qualified mortgage is and why you should even care. These are provisions that are going to apply beginning January 10th of 2014, and once they do, you'll be prohibited from extending covered credit without conforming to the ability to repay requirements. Now, these rules will affect virtually all consumer credit transactions secured by a dwelling. So, in complying with the ability to repay standards, there is something, or requirements, there's something called the qualified mortgage standards. And most bankers are probably going to want to try to make qualified mortgages because in so doing, they'll have significant legal protections. So we'll talk about the three different types of qualified mortgages that are already allowed for in this new rule, and we'll also cover an expansion of the qualified mortgage standards that may come into play under a concurrent proposed rule. We'll help you understand where you have some flexibility, where there isn't any choice except to do exactly what is required. We'll talk about what you have to do in terms of underwriting, when you have to use a new Appendix Q that's been added to Regulation Z, and we'll talk about what this all means for making balloon loans, how certain fees can affect your ability to qualify for safe harbor status, and we'll talk about where there are exceptions and where there are exemptions. So over on page 2, we've given you a laundry list of things we're going to talk about, from the 8 minimum underwriting factors to the points and fees limits, features you can't have in a qualified mortgage, and the 43% test and when it comes into play. This is, as I mentioned, a regulation of the Consumer Financial Protection Bureau, and it's under Reg Z. So when you're listening to what we're saying today, keep in mind that this only applies to loans that are to a natural person, primarily for a personal, family, or household purpose, that meet the other criteria here. On page 3, you see the breakdown of the different segments within Regulation Z, and this falls within Subpart E. There, thank goodness, is also official staff commentary for this, and some of the most useful material that the CFPB has published appears in the official commentary, and we'll be mentioning some of the material from the commentary from time to time. Remember always under Reg Z that good faith compliance with the commentary affords protection from civil liability, which is what makes it so important. But Jack's going to sketch out for us the scope of the rule to start us off.
All right. If you'll take a look at page 4, top of the page, we have the scope rules laid out. And as Mary Beth explained a moment ago, we're talking about consumer credit, closed-in consumer credit secured by a dwelling. And dwelling has the same meaning we've had for a long time, 1 to 4 family dwelling. Okay, so it's a pretty broad concept, not just your primary dwelling, but a dwelling. There are exclusions. Home equity line of credit are excluded. Now, let me clarify one issue there. You don't have to worry about verifying the borrower's ability to repay on a home equity line under this section. Mary Beth, I think it was a screw-up, maybe Congress, maybe CFPB, but I think it was Congress. You know, we had ability to repay rules for Section 32s and 35s.
That's right.
And they moved them out over here to Section 43. But then they also expanded coverage of 32, to keep my citation straight.
32, the high-cost mortgages.
Yeah, they put in open-end credit over there. So this rule didn't cover open-end, so now there's rules for verifying the ability to pay on open-end credit under a different section of the reg. So you do have to verify their ability to pay on a home equity line, just not under this section, and following basically the old rules we had under 32 and 35. Could they make it more confusing? I don't know. Also excluded is Mary Beth and I's all-time favorite, and that's the timeshare plans. They're not covered. And then if you look at item 3 at the top of page 4, it says, for purposes of paragraphs C through F. Well, folks, those are the different ability to repay options. We have what I call the 8 factors. You got the qualified mortgages, refinancing a non-standard into a standard, the balloon QMs. So when, in those options, what is excluded would be reverse mortgages, temporary or bridge loans with the terms of 12 months or less. I'm going to give an example of a loan to purchase a new dwelling where they haven't sold the old one, and so they're doing a bridge loan. And then also excluded would be the construction phase of 12 months or less of a construction to permanent loan. If you're doing just the construction financing, it's exempt. If you're doing just the permanent financing, it's covered. But if you got a combined construction permanent, that construction phase, that is the part that would be excluded. Now, the next little paragraph there, we talk about the ability to repay options. And options, we do have several of those. Look at the chart, the flow chart we gave you on page 5. And folks, we start up in the upper left-hand corner. And you know, there's a number of ways this could be set up. I set it up in this fashion because it makes sense to me this way, all right? But you got all these options you can choose from. So we start off, is your loan a qualified mortgage? And we'll spend a bunch of time explaining to you what a QM is later. Now, if your answer to that question is yes, then the next question is to the right, and it says, is the transaction a higher-priced mortgage loan? And actually, HPCT would be the correct terminology there, I believe. But in any event, if it is a higher-priced transaction, then it says there's a presumption that you comply. If you say, no, it's not higher priced, then you have a safe harbor. Now, Mary Beth is going to elaborate on those concepts here in a little bit, explaining the difference in liability between a safe harbor and a rebuttable presumption of compliance. Either one is pretty good. The safe harbor is better, okay? Now, if the original question, is it a qualified mortgage, if that was answered no, then we go down and say, well, is it a balloon payment qualified mortgage? You know, the basic QM definition does not include balloons, but there is a special rule where you can make a balloon payment QM. So that's the question we have here. Is it a balloon payment QM? And if you answer yes, well, then if you've met all the requirements for a qualified mortgage, but it can provide for a balloon. So it would allow you to have a QM that includes a balloon. So that would be a possibility. If you say, no, it's not a balloon payment QM, then we go down and say, well, does this loan refinance a non-standard into a standard mortgage? And if your answer is yes, then it's not required to comply with the ability to repay requirements. The fact that it is a standard mortgage would be sufficient. Now, you'll see when we get to that option, it's very narrow when you can use that option. But, hey, if it's available to you, use it. And then we drop down again and say, well, if you made a reasonable and good faith determination that the consumer will have a reasonable ability to repay, that's what we refer to as the 8 factors. If your answer is yes, then you comply with the ability to repay. If your answer is no, you've run out of options. No, it's not a QM. No, it's not a balloon payment QM. No, it's not a non-standard refinance into a standard. And no, we have not used the 8 factors. Then the answer is the loan can't be made. Can't make it. All right? Now, there is another option that we'll talk about later. It's proposed. It was in the concurrent proposal that Mary Beth talked about, and that is the loan a small creditor portfolio loan? I didn't include it on the chart because it's proposed. When it's final, we'll update the chart, but no use getting too concerned about it. Now, folks, that provision, when we get to it late in the program, is going to be very significant because I think it's going to be an option a lot of our typical listeners are going to want to spend some time hearing about that. So we'll get to that. Now, at the bottom of page 4, we talk about